So I don't find their analysis to be very genuine. I think that they're really just trying to move the market in a direction that favors their positions. And if anything, I expect they are selling into this uptrend, trying to get as much money as they can out of the market before they start going short and pushing things to the downside. Hello, everybody. My name is True Demon, and I'm the Devil's Stockbroker. In this video, I'm going to be covering the macroeconomic situation and covering the SPY and the broader market. So, without further ado, let's get straight into it. Right now, we currently have the SPY trading in what I believe to be is a bear pennant, kind of recovering off of this double top that we created here and here. So, we have a 1, 2 top and a drop, and then a retest. So, this is a double top pattern that I have been watching the SPY form over the last couple of days. I have seen a lot of people getting really excited about what has been coming from the Fed because Bostic stepped up back on Thursday, I believe it was. He walked out onto an interview and basically, when asked point blank if he was in favor of a 25 BPS or a 25 points rate hike, he said, "Yeah, I would be in favor of that, but I would need to be guided by the data." So everybody heard 25 bips and they turned their ears off and they said, "Go long." And they just went straight into the market, buying all the calls everywhere they could get them. And that sent the market rocketing up by $3 and then $6.38 one day after the next. Today, on Monday, what we have created instead is a shooting star or a meteor candle, which I believe to be is an extremely bearish pattern. It also actually technically meets the definitions of an abandoned baby because there is a gap between the candlesticks open and close from the previous day. So note this big green engulfing candle and the fact that the body of this red candle has gapped up and closed outside of the range of the previous day's candle. Now, this means that, well, it's basically two separate but both bearish candlesticks. And especially this very tall wick here on this candle, what it suggests is that the market attempted to break out at this very high level of $408 and it straight up failed. It got rejected and the market said no and sent it straight back down to where it came from. Now, there's two possibilities going down to the 1 hour chart for where I believe the SPY will react to different price levels now. For one, we have a support level here, which is marked by this gap, and we can see that there was previous support in this level before. And you'll notice that I have it marked in white. So while this is acting as support, I believe it to be very weak support because we've only touched this level once before we gapped through it and went to the downside. We have filled this gap now because of today's price action, which is why I believe we made this move in the first place. But I don't believe it to be very strong support. So there's two possibilities for what I think the SPY will do in the next couple of trading days. The first possibility being the bull case is it rebounds up to here and it starts to find more resistance at the 408 level. This level is acting as very strong resistance because if you look anywhere back here, you'll notice that this entire trading range has had some really hard time breaking through it to the downside. Just the same, we're going to expect to have some serious problems breaking through it to the upside. If this does end up playing out as expected, then expect the market to reject to the downside pretty aggressively because this is a very strong area of resistance. And if you'll notice, the RSI is pretty blown out right now. MACD is also crossing very aggressively outside of its price cloud, which you'll see is here on the price cloud oscillator by Peaceful Lizard. Big shout out to Peaceful Lizard in the Discord for creating this indicator. Absolutely loves this dude's indicators on TradingView. Moving on further, the other possibility is straight up just breaking through to the downside, which I think is actually the less likely scenario. I think that the SPY is more likely to chop in this area at least a little bit before we make a move to the downside. Because right now, everybody is just going gaga over the market pump from Bostic saying that he's in favor of 25 bips plus a bunch of Wall Street banks and firms saying that they are expecting this to be the market bottom. Ironically, I think that the consensus coming from these banks is possibly the least reputable because each of these banks have been really been countering the market with all of their predictions. So I don't find their analysis to be very genuine. I think that they're really just trying to move the market in a direction that favors their positions. And if anything, I expect they are selling into this uptrend, trying to get as much money as they can out of the market before they start going short and pushing things to the downside. On top of that, with this being a giant double top formation with a confirmation top if we reject here, that would send us going further down to retest our previous lows all the way down at $375. So none of these signals are very good to me. And if that wasn't bad enough, I have another one for you. You can actually spot a head and shoulders that is forming here, and we are just about to create another shoulder. See this shoulder level right here at $410? If we reject off of this and come crashing back through here, the neckline starts at 375. That means that we could go even lower to retest 350 on the SPY. So a lot of people think that I'm probably being overly bearish in this situation, that I'm probably exaggerating this. Well, I want to be perfectly honest with you. I'm not exactly going to be hurt by the market going down like this because I've prepared for it. But I do want to point out some of the other signals that I have been talking about for the last, oh, I don't know, year since we've been trading in this ridiculously overpriced market. And you'll notice that every single time on SPY over HYG, this is the SPY divided by the high yield grade bonds chart, every time that we have hit this level, where we have had this descending level of resistance on the ratio chart, we have received a pretty harsh rejection. We already got one rejection here, and then we move back down through it, and now we are retesting that ratio level. So if we hit this and reject, then that means the market's going to, at the very least, come back down to retest where it was when it formed this support on the ratio chart. For the SPY, this was at about $380 to $375, somewhere in this range. You can see the price levels for the SPY right here on this column. So why do I look at SPY over HYG? That is because the high yield grade bonds, which is an ETF chart that tracks junk bonds basically, is a greater indicator of market sentiment based on institutional trading. Institutions buy bonds, traders buy SPY. When bond markets are going down, that's usually because the institutions already know what's about to happen, so they are leading the market move. And you'll notice if you look at the HYG, that's this blue and yellow bar chart here, every single time there was a move to the downside in SPY, it happened almost 2 weeks after the HYG already started moving down. So you'll notice every area this is circled here, here, and here, market has been moving to the downside late. HYG always leads it by almost a full week. And this is how I was able to predict back here when the SPY was trading at around 415, $412, somewhere in that trading range. HYG was already breaking through an ascending wedge candlestick pattern. And that that was enough to confirm for me that the market was moving to the downside. Here's the other indicator. If you don't like looking for technical trading charts, you can just use SPY and HYG and look at the MACD. Every time there was a bearish crossover in the MACD on the daily candlestick charts here, there was always followed by it a little bounce and then a rejection by the MACD. So in order to show this a little bit more clearly, I'm actually going to switch to a different chart with a cleaner layout. So on this chart, there's only two things. There's the SPY divided by HYG. That's this little candlestick chart right here. And then this is the SPY itself. Each of these vertical dotted lines represents a crossover in the MACD. These are bearish crossovers. This is when the fast line crosses the slow line from to the downside at the very top of the chart. And you'll notice that I'm using a price cloud oscillator So it's a slightly modified MACD, but it's still a MACD. Again, every single time you see a bearish crossover on this, it marks a top in the SPY. Look at how reliable it's been. The first move in the market was the only one that was slightly inaccurate. It was delayed by a full 4 months before the market moved to the downside. However, it did move to the downside after a separate bearish cross down. So after the market had already made another top, this cross down proved to be accurate. So we have one win here. We had another cross down here. This actually came within a few days of the top of the market. So this one was also a win. And the market moved all the way down to $360. Here we had a separate cross down that saw the market moving all the way down to a low $350. We had another cross down up here. The market moved back down to around 375 from a high of 410. And now we have had yet another crossover that occurred back here. The market hit 415 and it is now moving to the downside. Additionally, what you may have noticed is if you get really, really close to the MACD on each of these, I'll go ahead and remove these circles so that you can see them a little bit more closely, but keep an eye on those crossovers. There was always a little pop, always a little pop where the market is trying to recover. See this? Every single time the market tried to recover, here, 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 and here, it coincided with a attempt to cross on the MACD. That's exactly what we're doing right now. Every single time, the market rejected that cross and moved sharply to the downside, faster than the initial drop from the top of the market. So this is exactly what SPY and HYG are indicating to us is coming very soon. So right now, all of this is set up to be a great big bull trap. Whether we get one more day of green or 5 more days of green, I don't care. In the long run, 30 days from now, I am anticipating the market to plummet very quickly to the downside. This is the dollar index or the Dixie chart, which I am also looking at very closely for something very similar. Right now, the dollar has been trading a bit low. If you go back in time, the dollar was moving very strongly throughout the pandemic and late 2022. This is when the inflation monster really started kicking us in the teeth and everything started to get ridiculously out of control. Dixie hit a top at around 113 to 114.50 on the dollar index. And then it started moving down, and the market kind of started to recover a little bit. So far, it hasn't been really good for the market, but I can tell you that with certainty that if the dollar index is moving up, then stocks are not going to like it. It's not going to do very well. The dollar index almost universally indicates weakness in the market when it is moving up. Right now, the technical chart shows that the dollar index has formed a cup and handle, and lately, bulls have been pointing to the fact that the dollar index is moving down as a very bullish signal. Note, the dollar index is, in fact, moving down. However, what you'll also notice is it's not moving down very much. It's actually been forming support at $104 ever since it broke through that level. And it's still been maintaining this level. Until it breaks $104, I don't think it comes even close to signaling a bull market has returned. And worse yet, because this is a cup and handle, which is a very accurate technical pattern for Forex trading, by the way, this indicates that the market is going to move to the upside on the dollar index. So if the dollar index starts ripping through the top of this cup and handle, it's going to send the market into another wave of inflation because when the dollar index is showing strength in the dollar, that always means more inflation. It's also going to mean extreme pain for stocks because the dollar index shows that it is actually a safer asset than the rest of the world currencies. So all of the other foreign currencies may consider moving to the US dollar because despite what everything else is doing in the world, the dollar is still the best right now. So if the dollar index continues to move, or rather, if the dollar index ends up reversing to the upside, strengthening the dollar simultaneously with sticky inflation reports or a CPI showing hot or equal numbers to last month, then it's not going to be good for the market. And everybody who is getting super bullish about everything is really jumping the gun. I want everybody to really carefully consider this stuff and do your own research, please. Don't just take my word for it. Go out and start Googling some of this. I don't have to be the only soothsayer here telling everybody what's going on in the economy. Go look for some other sources. Don't just pay attention to me and what I'm saying. Go find other sources. And what you will find is that anybody who is worth their salt as a trader who has been doing this for more than 5 years and isn't a complete dummy, they will tell you that dollar index moving up equals bad stock market. So, just to reiterate one final time what we are currently seeing, the SPY showing multiple bearish patterns, including a potential head and shoulders that may be playing out here in the near future. Definitely showing a major double top pattern that if we break to the downside through 390, we will absolutely be seeing 375 once again. If this ascending triangle breaks down, we are going to be going down to 390 in the near term. Lots of bearish setups here. So please be careful about any bullish news that you are hearing and make sure that you are very hyper fixated, focused, and analyzing about what they are saying and what their motives are for saying it. Because you cannot trust the banks that are telling us that the market is recovering right now when it is very obvious, according to the Fed, the CPI, the PPI, and other inflation indicators, suggesting that the market is still not in a healthy place. I want to wish you guys the absolute best of luck in your trading going forward. This is all I have for you in this video. I look forward to seeing you in the next one. But until then, a hell of a time in the market. Thank you guys so much for tuning in to watch this video. If you enjoyed the content and you found this information helpful to you in your own trading strategies, be sure to leave a like on the video. It helps out the YouTube algorithm and helps us reach out to others who need this information too. Be sure to subscribe if you want to see more. And if you're not a member of Hell's Trading Floor already, consider joining our Discord by joining us at hellstradingfloor.com, which will allow you to sign up for our Discord at discord.gg/hellstradingfloor. Thank you guys so much for watching, and I look forward to seeing you in the next one. Until then, have a hell of a time in the markets.